90. Hi all, very good evening. Now I will be talking about the Direct Tax Amendment in Finance Act 2022 as a continuation to Madhuri's session. I will straightly go to the topic. First, I will discuss on changes in Pds sections. 194R, a new section is inserted. We know the value of any benefit or perquisite arising from business or profession is to be charged as business income in the hands of the recipient. The problem is, in many cases, the recipient is not reporting such income. That is the reason for inserting this section 194R. So this is applicable to every assessee, any person who is responsible for paying any benefit or perquisite to a resident payee which exceed 20,000 in a financial year shall be liable to deduct a TDS of 10%. So it is clear that the limit is 20,000. That is, if the payment is in less than 20,000 in a financial year, this TDS section will not be applicable. And it is also mentioned in the section that this section is not applicable to individual and HUF whose total sales or gross receipt does not exceed 1 crore in case of business or 50 lakhs in case of profession during the financial year, immediately preceding the financial year in which such benefit or perquisite is given. Means, if I want to give a payment in financial year 2021-22, I'm an individual, I need to look my turnover of business in the financial year 2021. If that turnover is less than 1 crore, this section will not be applicable to me. And this amendment will take effect from 1st July 2022. Next is the introduction of 194S. This is already discussed by Madhuri. TDS on payment for transfer of virtual digital asset to a resident payee at the rate of 1%. Directly moving to the next TDS section, TDS on sale of immovable property. We all are familiar with this section. That is, we have to deduct TDS at 1% if consideration on sale of immovable property other than agricultural land is excess of 50 lakh rupees. This section was completely silent on stamp duty value of property. So there was a confusion that if the stamp duty value is higher than the consideration, then whether to deduct TDS on stamp duty value or sale consideration. This is clarified by the budget 2022 that if the stamp duty value is different from the sale value, then for calculating TDS, we will take the higher of stamp duty or the purchase consideration. For example, if the consideration is 49 lakh and the stamp duty value is 51 lakh, then we have to deduct TDS at 1% on 51 lakh. Next is amendment to TDS for non-filers of income tax, section 206AB. This is the new section inserted in Finance Act 2021, that is in the last budget, which came into effect from 1st July 2021. This section says that if you pay any amount to a specified person means non-filers of income tax, then tax shall be deducted at the higher of twice the rate in force or 5%. And this section is not applicable for TDS related to salary, payment from provident fund, winning from lottery or crossword puzzles, winning from horse race, income from investment in securitization trust, and TDS on cash withdrawal. And now the amendment is 2 more sections also excluded from the scope of this 206AB. That is payment on transfer of certain immovable property and TDS on payment of rent by certain individuals and HUF. That is 194IA and IB also excluded from 206AB. That means, I will give an example. If you are making a payment as salary to a specified person, if that person is a specified person, even though he is a specified person, the section 206AB will not be attracted. Normal TDS provision will only be attracted to such payment. And the next amendment to this section is on the definition of specified person. Specified person, before this amendment, specified person means a person is treated as specified person if he fails to file the income tax return for 2 previous years immediately prior to the previous year in which tax is to be deducted for which the time limit of filing return of income has expired and the aggregate of TDS in his case is excess of rupees 50,000. That means to attract 206AB, 206AB will be only attracted if the assessee fails to furnish income tax return for 2 years and the TDS exceeds 50,000 in that 2 years. If I have to check whether a person is specified person, for an example, for making a payment in financial year 2021-22, then I have to check whether the person has filed the ITR in financial year 2021 and 1920. And the amendment here is this 2 years has been reduced to 1 year now. So from now, that is, if the person did not file ITR for 1 year, he will be treated as specified person and 206AB will be attracted. And this amendment will take effect from 1st April 2022. This change in definition will be applicable for tax collection at source section also, that is 206 CCA. Moving to the next topic, Tax Incentive to International Financial Service Center, IFSC. We know over the past few years, several tax concessions have been provided to units located in International Financial Service Center. Like there is no security transaction tax and commodity transaction there. And the MAT rate is 9%, concessional rate. In order to further incentivize the operation from IFSC, it is proposed to provide the following additional incentive also. That is, the following income of non-resident will be completely exempt from tax. Income of non-resident from offshore derivative instruments, from counter derivatives issued by an offshore banking unit, income from royalty and interest on account of lease of ship, income received from portfolio management service in IFSC. This income of non-resident will be completely exempted. Next is clarification of health and education cess. We know that income tax is not allowable as a business expenditure. However, several assessees are claiming exemption on health and education cess since this is a newly introduced cess. So in this budget, it is clarified that health and education cess will be treated as income tax and will not be allowed as expense. Next is deterrence against tax evasion. We know we can set off losses arising from one head against the another and carry forward that losses and can set off the brought forward losses against the current year, subject to some conditions. But it is clarified that this set off of brought forward losses is not allowable against undisclosed income detected during search. For that, a new section 79A is inserted and it says that no set off of brought forward losses against undisclosed income detected during search and survey operations. Next amendment is on cash credit, section 68. Section 68 provides that where any sum is found to be credited in the books of assessee and the assessee fails to explain the source of that credit, then this credit will be treated as income of the assessee and the assessee will be liable for income tax on that credit. The responsibility of giving explanation was only on person whose books amount is credited. But after this Finance Act amendment, this Finance Act mandate explanation of source of fund in the hands of lender also. Meaning the person who provided the loan or borrowing should also explain the source of fund. Otherwise, the explanation given by the assessee will be treated as non-satisfactory and this will be treated as income of the assessee and the assessee will be liable to income tax. This will be effect from 1st April 2023. Next is withdrawal of concessional rate of taxation on dividend income. Dividend received by an Indian company from a specified foreign company will be shall be taxable at a concessional rate of 15%. The specified foreign company means a foreign company in which Indian company holds 26% of more of the equity share capital. This budget says this provision shall not be applicable from 1st April 2023. That means From 1st April 2023, this dividend received by an Indian company from specified foreign company will be taxable at the normal tax rates of the company, that is at 25 or 30% as the case may be. Then moving to the next topic, clarification in respect of disallowance of expenditure incurred for earning exempt income. That is under section 14A. It clearly provides that if the income is exempted, then the expenditure related to that income also will not be allowable. However, there was some confusion that if the expenditure is incurred, but the exempt income is not earned in that year, whether the expense will be allowable or not. Some courts have taken a view that if there is no exempt income during a year, then no disallowance can be made. So in this budget, it is clarified that expenditure incurred on earning exempt income shall be disallowed irrespective of whether such exempt income is earned or received during the previous year. For an example, if I incur an expense of 1 lakh to earn 2 lakh taxable income, this 1 lakh will be anyway allowable as expense with 2 lakh, and 50,000 expense to earn exempt income, which is not accrued in that year. Now the question is whether this 15,000 will be allowable as expense or not. So as per this new amendment, this 15,000 will not be allowed as expense, irrespective whether the exempt income is accrued or not in that year. The next topic, litigation management to avoid repetitive appeals by the department. If a question of law in case of an assessee is identical to a question of law which is pending in appeal before the jurisdictional high court or Supreme Court in any case, the filing of further appeal in the case of this assessee by the department shall be deferred till such question of law is decided by the High Court or Supreme Court. This will greatly help in reducing the repeated litigation between taxpayers and the department. Next to the new section 239A. We know when we are making a payment to a non-resident, we have to deduct TDS under section 195. Assume suppose a person who deducted tax on any income paid to a non-resident under 195 other than interest, and the tax is borne by him, and in the later he concludes that such payment is not liable to TDS, then now he have an option to file an application with the assessing officer and claim that refund. Before, there was no option of assessee to approach the assessing officer for refund. He has to go for appeal. This section will be applicable from 1st April 2022. Then some amendments regarding trust and institutions. We know a trust registered under section 12 has to apply 85% of its income in order to claim tax exemption. We have an provision that if this 85% is not utilized in a year, we can set apart such income in accordance with the section 11 for 5 years. And we can claim exemptions, but we have to fulfill some conditions. That is, we need to file a declaration before due date of filing ITR for claiming such exemptions. Such an option was there for 1023 institution also for claiming exemption. If they have not utilized 85%, they can set apart such income and claim exemption. But the condition restriction of filing declaration before the due date was not there for 1023C institutions. 1023C institutions means in universities, educational institutions, hospitals financed by government, which is not functioning for profit, or universities, educational institution, hospitals whose annual receipt does not exceed 1 crore. So such institution can also set apart this 85% income, but the restriction of condition was not there to file the declaration before the due date of filing of ITR. Now that conditions is extended to these 1023C institutions also. So from now, if they want to claim the exemptions of set apart income, they need to file the declaration before the due date of filing of income tax return. Then the next amendment is, if the set apart income is not utilized within 5 years, then it will be taxable in the 6th year of income. Now it is changed that if it is not utilized within 5 years, it will be taxed in the 5th year itself, not in the 6th year. It will be taxed in the 5th year itself. both for trust and 1023C institutions. Moving to the last topic, tax rates. There is no change in tax rate except the rate change mentioned in the MAT and surcharge. So individual existing tax rate will be continuing. Individual and HUF will be having an option to pay tax under old or new regime. The firm tax rate will be 30%. Companies will be 25% if the turnover in the financial year 1920 is less than 400 crore. In other case, it will be 30%. And changes in surcharge are, in the case of association of person that is formed by several companies for the purpose of execution of work contract, a graded surcharge of up to 37% would get attracted on income of AOP. That rate now has been capped at 15%. So a cap of surcharge of AOP 15% is introduced. Further, long-term capital gain on listed equity shares, units, etc. are liable to a maximum surcharge of 15%. But while the other long-term capital gain was subject to a graded surcharge, which goes to up to 37%. This budget is now capped the rate of surcharge on all long-term capital gain to 15%. And now surcharge on cooperative societies is also reduced to 7%. That's it. Thank you.
Thank you, Shruti.
Yes.
Your sharing is okay.
We'll stop.
Yeah, so thank you, Shruti. It was good. Madhuri and Shruti, you did a good job.
Thank you, sir. Thanks.
Now I request my colleague, a close friend, Unni. I will just unmute you. Unni, you have to say a few words. Unni is a partner in one of the leading firms in Bangalore, Vasan & Sampath, and he has joined us. So thank you very much. So we want to hear from you, maybe some few minutes on your take on the budget. Unni?
Sure. Thank you very much. And first up, big congratulations to all the panelists who presented. Thank you for making a nice and crisp presentation. It was very useful to me also. Let me start with some points like Kuti is requested. So disclaimer, I'm not an economist, but just some some thoughts at a macro level, both as a citizen and a finance professional. Overall, for the budget numbers per se, I think it has a very clear thread of credibility, consistency, and continuity. So I think that's a very good thing, and that's something that I think most folks, including international funding agencies, look at. So I think that's very good. One of the things at a macro level, which I see was not addressed, was with regard to the global. I mean, maybe some indications on how we're going to deal with changes, especially if it's unfavorable changes in one global interest rates, and the other one is on global oil or crude prices. I just hope we don't have any surprises on that front. Coming specifically to some of the economic stuff, the huge capex spending that is there and the thrust on infrastructure. I think the economic survey very clearly also brought out that the personal spending levels were still low. So in light of that, the government's thrust on capex spending, 750,000 crores, I think is a very positive move, a step in the right direction, and is kind of really required, especially if you're talking about improving infrastructure and competing in a global space, potentially taking over some of the manufacturing from China and all that. So it's not just the manufacturing setup that is required, but all the other infrastructure, whether it's roads, ports, electricity. So a lot of that has been addressed. I think that's a very positive move. And the other one that I looked at and was excited about was with regard to the impetus in the International Finance Center, or the GIFT City in Ahmedabad. They've tried to make it more integrated, not just with the banking and finance activities, but also inviting universities to take part and be part of that process. So I'm waiting to see how that pans out. But overall, on that whole part, I think the key is execution and effective implementation, which has always in the past been a challenge. We really hope that the government and the machinery around that takes that, and we see some positive outcomes from there. Indirect tax, I'm not going to talk much about it. I know there has already been discussed, and Kuti himself is going to touch upon a few more activities. But again, just as a policy, I was very happy to see that the some of the import tariff rates being increased, which is in line with the thrust or the encouragement for shifting some of those products to be manufactured in India. So I think that's a very welcome move from an India manufacturing and SME standpoint. From an income tax perspective, while of course they've not changed much, which is definitely useful. Couple of things which I was hoping will be done, but I don't see, and maybe that's reason for maybe some dissatisfaction, especially among the salaried employees, is that I was hoping that there would be some increase of ATC limits, especially for housing loan repayments, which again would have tied in with the thrust on housing for lower and middle income groups. So that didn't come. I thought that is something that they could have done much, which would have, they could have done something and which would not have really had a huge impact on taxation per se. And the last one, again, which what I would call a miss, is with regard to taxation of ESOPs. Given that we work with so many startups, and there is a growing startup ecosystem in India, and closer home at Bangalore itself, I think they should have made the whole ESOP taxation regime a little more tax friendly for employees. It's not happened, but hopefully that will come up sometime soon. So these were some thoughts on the budget, but otherwise I think overall positive. It's all about the implementation. Thank you very much for the time, and pleasure being part of today's event.